Wednesday. We're back for another live stream, and today we are talking about Trump's big, beautiful fix for housing. He's the man with the plan. He's delivering the 50-year mortgage, but is that really the fix that Americans need? We're going to talk about the potential pros and some of the cons that come from the 50-year mortgage. So stick around, stay tuned for that. And we have a very special guest this evening, one of my good friends and colleagues. She's a mortgage expert, and she'll be giving us all of the important information when it comes to this 50-year mortgage stuff. So we'll be going through all of that. As you guys know, my name is Joe. Thanks for hanging out on the channel. Every Wednesday, our normal time is 6:30. We're doing it a little bit earlier today. We're doing it at 6 o'clock today. We moved it up just a little bit, but it's a one-time only special. Thanks for hanging out. Appreciate you being in the stream. Right down here is the like button. Please go ahead. If you're watching right now, please hit that like button. If you're watching the replay, hey, hit that like button. It does help me out. It's absolutely free, helps the channel. And if you would be so kind as to consider to subscribe, it would also help out a ton. So we got a lot to get into. We're going to take a look at one really unique property. Actually, the property itself is not that unique, but it's got a really cool special feature. So we're going to go through that really quick. And then we're going to get to a video that talks about President Trump, and then an article, and we're going to break it all down. So let's get going. And you know what? I'm going to bring out my guest now so that we can get her opinion on this normal / crazy house. So let's get Miss Monty Pitzel on the stream. Hi, Monty. Thanks for being here.
Hey, Joe. How you doing?
I'm doing well. We're going to talk about all the 50-year mortgage stuff. But before we get into that, I saw a very fun house on Zillow Gone Wild, which is like one of my guilty pleasures. I love Zillow Gone Wild because you always see something cool. So let's go to where is this? I don't even remember where this is. Let's see. Oh, this is Ohio. Okay, guys. So, and Monty, this is maybe the first time you've been with us for something like this. So we usually try to find a house that's got some really cool features, something super unique, something weird. And I found this one. And this home looks very normal. Looks like your regular old Midwest brick house. And as you go through the photos, it's like, why would Joe, this is kind of, it's nice. It's fine. Nothing crazy. It's nice, but wait until you get to the basement. You think, it's very generic, like fine, normal house, right?
Yeah.
Pretty good. Wait a minute. We're getting there. It's got like a full blown like Irish pub. Yeah.
Wow.
Yeah. This thing is for real.
Like, a lot of wine.
I saw this photo and I was like, is this where you wait for the hostess? Like to be seated, like the host stand should be right here. And this is where you wait. And they're like, oh, good evening. Let me take your coat. It's got the wine racks all across the back of the bench here. You can see there's a huge like stone fireplace in this corner. It is wild, and it gets wilder. So this is like the pub area, right?
Yeah.
So it definitely has that like Irish, like European, like dark, cozy pub thing. And my first thought is like, you must really enjoy a beverage in order to like build this in your home.
And have a lot of friends.
Yeah, there you go. And have a lot of friends. Otherwise, it would be a huge waste.
Right.
Just did this by yourself. So, I mean, they really went crazy. Obviously, we've seen our fair share of luxury homes, and we've seen homes that have kind of cool special features, the homes that have built-in bars or stuff like that. But I don't know if I've seen anything to this extent.
No,
right? This is pretty unique.
It's beautiful though.
I mean, look how cool this is. And you could imagine like, Ohio, now it's fall and winter. It's a little snowy. It's a little rainy. It's a little cool. You've got the big fire going in the stone fireplace. You're in the nook in the corner. I mean, you got the football game on. It's like, I don't know. It seems pretty pleasant.
I'm ready to have an Irish coffee.
Yeah, there you go. It's a great spot for some Irish coffee. And after it even comes complete with its own like pub style bathroom. So, which obviously is mandatory. You gotta have that. And then when you've enjoyed a few cocktails, you need to maybe run off some of that alcohol.
Holy cow.
Shoot hoops on your indoor court.
That's crazy.
Right?
That is crazy.
Yep. It's got the adjustable hoop. Like it's not quite the size of a half court, but, and then I wonder, like, was this room built with this intention, or was like the husband just like, you know what, we're putting wood flooring down, we're not putting any furniture in, I'm hanging a basketball.
Possibly, yeah.
I need to know the origin story of this room.
I need to meet the people who bought it.
Yeah, right. What are they like? Well,
yeah.
Probably some interesting characters. Hey, Innovative Solutions, how's it going, buddy? Good to see you in the stream. His wife bursts through the door just as he finishes the bill. Great news, honey, the prohibition has been lifted.
True.
Yeah, right. He's like, dang it, we were gonna make some money. Oh, geez.
That's
man.
hysterical.
So I stumbled across this and
Wow.
certainly had to bring attention to. Of course, what pub is not?
You've got to have a pool table.
Got to have the billiards, right?
There's got to be a dartboard there somewhere too.
There is somewhere, I'm sure, but they didn't show it. And then I love how this listing is like a bunch of like very normal generic photos, and then like 7 photos of crazy like pub and indoor basketball, and then it just goes like right back to here's
just normal.
Wow, just there it is.
That so this is, and do I see that right? 1,325,999.
Yes, for almost 7,400 square feet.
Unbelievable.
It's the Midwest, baby. I mean,
I guess. Yeah.
I mean, what do we think here in our market, Mondi? What is this? If this was, if this was in your neighborhood, this would be like a type of home in your neighborhood. If this is in your neighborhood, this has got to be what, 2.5?
Probably closer to 3.
Yeah, maybe even closer to 3. Yeah. I mean, but in Ohio, it's just a slim 1.325.
Wow, crazy. That's fun.
Yeah, very, very interesting. So, anyways, that is 860 West Hill Drive, Gates Mills, Ohio. If you are interested in a very large home with a very custom pub in Ohio, there is your winner. Oh, wow. Boy. All right, guys. So we're going to get to the main event. We're talking tonight about Trump's 50-year mortgage proposal. And we're going to get all into it. And for those of you that maybe you're joining a little bit late, we have Mondi Pitzel here with us. She is a mortgage loan officer, and an excellent one, might I add. And we have helped a lot of clients, and she is basically like a mortgage guru. So I've invited her onto the show. I don't have a ton of guests. So you guys know when I have a guest, it's very special. And I invited her onto the show, and she's going to give us her take on what she thinks as a professional. And of course, we're always here to answer your questions. The best part about live streaming is hanging out with you guys, chatting with you guys in the chat. So if you have questions about 50-year mortgages, refinances, if you have questions about buying or selling, or really anything related to real estate in general, and you're tired of getting like Chat GPT answers and Google answers, and you actually want a real live human, or humans in this case, to address your questions, now is your opportunity. So the chat is open. So please sound off with whatever your thoughts are. We're going to start first off, Mondi, in very succinctly, and we're going to get into more detail, but just in like 2 sentences, what's your overall opinion of the 50-year mortgage proposal?
I think it's a lot more media than it is value. I think that the value it brings is going to be substantially less than what it's supposed to. I think it's more generating the media attention right now, and I think there are better things we could be doing to help the homeowners.
Yeah, I don't disagree. I do not disagree. All right, guys. So we are going to watch this video from CNBC. And it's only 3.5 minutes, so we're going to let it go. We'll probably pause it a couple times. We'll interject. And let's see what CNBC thinks about 50-year mortgages.
In an attempt to make home buying more affordable, President Trump floated this idea of a 50-year mortgage in a social media post. The purpose of a longer-term fixed-rate mortgage would be to lower the monthly payment for homeowners. The longer the term of the loan, the smaller the principal needed each month to pay it off in full.
Pretty basic principle, right? I mean, if you borrow money and you're given a certain amount of time to pay it back, The longer that term is, the lower the monthly payments need to be because you're making more payments. So you're basically just kind of softening the blow over a longer period of time, which is sort of the rudimentary idea in how this could help people. But there's some catches to that, which we'll talk about.
Using the latest median sale price of a home from September, $415,200, according to the realtors, and the current interest rate of about 6.3%, according to Mortgage News Daily. On a 30-year fixed loan with a 20% down payment, the monthly payment of just principal and interest would be $2,006. Now, if you raise the length to 50 years at the same interest rate, that payment would be $1,823. And that's
okay. So at this stage, you might be like, well, there you have it. You know, there's $233 a month saved. But if you go deeper, it's not quite that simple, is it, Mondi?
Nope, not at
No,
all.
it's not. And they're gonna explain this a little bit further on why you can't just operate off of these facts and figures that are on the screen right now, because these are rudimentary and actually what they're showing you is not correct, but they're going to correct it here in a moment.
a savings of $233 a month. Homeowners, however, wouldn't build equity as quickly, and that's because their principal payments would be smaller, and the amount of interest that they're paying to lenders would actually be 40% higher. Homeowners could still gain equity through home price appreciation, but home prices have been softening swiftly across the nation this year, with nowhere near the appreciation seen in the years before.
Now that, Mondi, when I heard that line, I get what she's saying, and it makes sense, right?
Mm-hmm.
But you know, I always try to be as really analytical as possible, and well, as you know, and my first thought with that was, well, yes, the 50-year makes it cheaper, but when you get down into it, it's not cheaper.
It's not over time. It's not cheaper. It's
right.
Like leasing a car for 3 years versus 6 years.
Right.
The car's the same price. It's just you're going to pay a lot more to have it over that 6-year period. And it's the same with a 50-year mortgage.
Yeah. Remember, in anything, but especially business, there's no such thing as a free lunch. Nope. So if someone is going to do something for you that's like, wow, that's very generous and favorable, there's probably a catch.
Right.
Now, even realtors agree that the savings to homeowners would be minimal. Joel Berner, a senior economist at Realtor.com, said in a release, "This is not the best way to solve housing affordability. The administration would do better to reverse tariff-induced inflation, which is keeping the rates on existing mortgages high." The average age of a typical first-time buyer in 1991 was 28. By last year, it had reached 38, according to a new report from the National Association of Realtors, whose deputy chief economist called the number, quote, shocking. Then there's the question of what's...
Now, I'll quickly interject on that number. I've seen that come out a couple times. I don't know if you saw this, Mondi, but I think homes.com did a press release that was, the new first-time homebuyer age is now 40 years old, up from... And what I saw, they said it's now 40 years old, up from the late 20s in 1990 something.
Mm-hmm.
And I thought to myself, that's a great piece of like media work. I love how they go, late 20s to 40. Okay, that could be 28 to 40, which in reality is not a huge jump.
Well, they can manipulate statistical data to get wherever they need to go to give you this number. So
right.
I'm not sure I buy it based on a lot of the clients I work with. So I don't know.
And I'm sure there's also, whenever we take those big averages, when you have averages, they don't take into account, region specific. So in some areas there, it could be higher, it could be lower. And that's why sometimes people like to look at median age or medium figures instead of averages, because the averages can be outweighed by outliers. Mm-hmm. When I heard that, my first thought was like, well, I mean, yes, that's not a good stat. Don't get me wrong. It's not a good thing that the average age for her first-time home buyer is going up. That's not ideal in our world. However, people are like graduating college later. People are getting married later. People are having kids later. People are dying later. I mean, everything is just kind of happening a little bit later in life than it was even just a decade ago, and certainly 20 years ago. So
they're trying to attribute it to one cause when there could be much more causation from a lot of other social things that are creating that number to go up as well.
Right. And that was my thought too. And then to say, oh yeah, late 20s to 40. Oh my God, that makes it sound like, oh, it's a 20-year gap. When in reality, it's closer to like a 12-year, 11-year, gap. So again, just interesting things that we see. All right, Innovative, what do you got for us? The 50-year mortgage is to a homeowner what a $400,000 student loan for an art history degree is to an 18-year-old.
Great analogy. Absolutely.
That is excellent. Yeah, that's exactly right. You're going to be paying for it for a really long time, and the value that you get out of it's probably not great. Hey, we got Robert G in the house. How's it going, Robert? Thanks for hanging out. All right, let's get back to it.
The mortgage rate. The average rate on the 15-year fixed mortgage is currently 66.
Oh yeah, this is an important part. Remember back when this video first started, said they showed you some wrong numbers. They're going to break that down right now, and this is like mega important. And Mondi, we're going to talk about this a little bit more as we get into it. I'm going to go back a little bit because this is important stuff. All right, pay attention.
Question of what's the mortgage rate? The average rate on the 15-year fixed mortgage is currently 66 basis points lower than the rate on the 30-year fixed. So this would kind of imply that the rate on the 50-year fixed would be higher. It all depends on investor demand for the product, of course. I spoke with Matthew Graham at Mortgage News Daily. He told me there is not currently a secondary market for these loans, nor would a robust secondary market be cultivated anytime soon. That means that in addition to the extremely low amount of principal paid down in earlier years of the loan, the interest rates would also be quite a bit higher than 30-year loans. He calls that a double whammy for those with any hope of building home.
Let's just pause right there. If everybody could take a moment and just read that one quote on the screen, I think that kind of sums up the utility of the 50-year mortgage. A double whammy for those with any hope of building home equity. That's the whole idea. I mean, that's not the whole idea of owning a home, Mondi. Obviously, the idea of owning a home is to like secure your shelter, have a roof over your head, provide for your family, your loved ones, have safe, stable, living environment. But in a close second to that is building equity, right?
Yeah, and building wealth. Your home is your single largest, for most people, investment that they have. Yeah. And this is going to make it a little bit harder to do that, or a lot harder.
Yeah. It's almost like, if you were, in a race and you were jumping hurdles and halfway through the race, the hurdles got twice as high. And you're like, what's happening? It's going to significantly slow you down. And for 98% of the people in the world, certainly in our nation, real estate is how the commoner can be financially secure and create that wealth that, we all want. So, when we're met with a tool that is sort of disguised as something that's meant to be helpful, but in reality, it could actually further the outcome that most Americans want. Well, then it's probably something that's not worth having, in my opinion. Let's see what Innovative's got. Always got something good. Were you guys surprised at the public blowback? People are finally paying attention. Mondi, what do you think? Were you surprised at what you heard, not just in the mortgage or real estate world, but just on socials from clients or just the general talk?
I think social media is changing all of that because people can have conversations like this about it and then post their feelings. I mean, Pulte is getting, the head of the FHA and the Department of Housing. He's really getting a lot of blowback right now because apparently this was his idea. Yeah. He is a former owner of Pulte Homes, which we all have seen out here and across the nation. Yep. But yeah, he is getting they didn't vet this, is my understanding, before they released it to the media. And wait a minute. Yeah, can you imagine? I can't imagine that happening.
That would never happen in this administration.
It would never happen. And I think the media was surprised by the blowback because, gosh, doesn't a 50-year mortgage sound phenomenal? And don't you think you're going to save hundreds of dollars every month?
Yeah.
It just didn't, as with most things right now, it just didn't go through much vetting before it was released. And people, I think in the time I've been in this industry, people are much more astute now than they ever used to be. And that's
Yep.
because there's so many more resources available to people.
Absolutely. Yeah. And you make a great point with, obviously, with social media, YouTube, Instagram, TikTok,
Yeah.
within 1 minute, 2 minutes, you can, if you've got a lot of followers, you can get this message out, and all of a sudden 10,000, 15, 20,000 people
Right.
now are like, wait, 50-year mortgages, people that maybe would have had no idea that this was even proposed because maybe they're not in the home buying market,
Right.
or maybe they're people that are like, oh, maybe in a year or two we'll buy, and they're not really paying close attention. And all of a sudden they hear rumblings of this. I personally was quite surprised at the overwhelming agreement of the general American populace on anything. I
Yeah.
mean, it's like, I don't have children, but I would imagine it's like getting your 4-year-old and your 7-year-old to agree on what to have for dinner or what to watch on TV. I mean, it's just like, I was just amazed that it seemed like people from all sides of the aisle, every
Yeah.
which way. I mean, I don't agree with many politicians, but politicians that I never agree with, they would put out a statement. I was like, dang,
Yeah.
I agree with you. This is ridiculous. So I think the most interesting thing to me, and the most surprising thing to me, was just the general agreement of the public
Yeah.
regarding the 50-year mortgage announcement. And I have yet to see one single person make a compelling argument as to why it would be helpful.
Well,
But
I think once anybody looks at the payment comparison,
Yeah.
$200 a month, that really is not a lot to make a difference for the average home buyer, whether they're going to
No.
buy a home or not. It just
and
is.
especially, yeah, you're exactly right. And obviously that's going to change with, your down payment, the loan type, price, all that stuff. But think about it, Monty. I mean, what do we need the 30-year mortgage rate to come down to get that same result? We're at 6.3. I mean, heck, if we got it down to probably 6%, we'd probably be in the same position.
Psychologically, if the rates would hit and stay, the key to that is staying for a sustainable time below 6. Well, the minute we get a 30-year rate that's going to hold at 5.875 or lower, it will psychologically, it changes the attitude of the average home buyer. Same thing we see when rates go up. There are these benchmarks they pass, and different buying impulses happen, or they don't buy. But everything I've read from my experience, I think if we see these rates start hitting below 6% and staying there for 3 to 4 months, I think you'll see buyers start coming back into the market. And that's the other thing nobody talked about with this, is that, yes, you're going to reduce their rate, but let's just say it did give some great advantage, and it did, the media attention brought a lot of new buyers into the market.
Yeah.
That's not necessarily a good thing, because we still have a supply side problem with inventory.
Yep.
So you get too many buyers pushed into the market, what's going to happen? Your home prices are going to start appreciating again because you have a supply and demand issue happening.
Yeah, exactly. I was just having that conversation with a colleague of mine in the industry, and I just simply the subsidies, when you over subsidize an industry, it becomes problematic. Yeah. And the American real estate market got the greatest gift with the 30-year fixed rate mortgage. And we hear this all the time from real estate professionals not in the United States. Go to Canada, go to England.
Yeah.
Where they go,
it's really hard.
Fixed rate mortgage.
Yeah.
You guys are stupid. What are you doing over there?
Yeah.
I mean, for the American consumer, it's great. But just the 30-year fixed rate is such a wonderful tool. And my position was, we're on the verge of especially with a 50-year mortgage, we're on the verge of over subsidizing the housing market, and any subsidies that drive up demand is the opposite of what we need. If we're going to subsidize something, it needs to be on the supply side. Correct. So that we can try to get some more supply or open up more supply, which is why we've had this conversation, Monty, raising that capital gains limit, right?
Eliminating it or raising it so that more people, we've had so much appreciation in the last 10 to 15 years, since 2008, really, that a lot of baby boomers are hanging on to their houses. They're putting them into a trust because if they stay in their home and it transfers via their trust, then they get a step up in value and the taxes go away, the capital gains after they pass. And so a lot of baby boomers aren't doing what they've done before, which is selling their big home and downsizing because of the capital gains they're going to have to pay on that $1 million potentially on some properties in California. And you mentioned subsidies. I can't help but bring this up, Joe, because we've already seen subsidy in action, and that was during COVID. Rates were artificially pushed down to keep everything stimulated. They were overstimulated, and look what it did to home values. I mean, I remember we had properties going with 50 to 75 offers. Talk about pushing people in demand and not having the supply side in check. That really caused a lot of difficulty with affordability. So we've seen that subsidy in action and the unintended consequence of it.
Yeah. And that's where we are now. And I think that, the general kind of rule of thumb, and this is where, our boy, Logan Motoshami, has a lot of great advice. He basically just says, listen, and again, I talk about Logan a lot on the stream. I listen to Logan every day on his podcast. And if you're someone who really wants to get into like the analyzing the housing market and the nuts and bolts of it, I think he's probably the premier housing analyst in the country, in my opinion. And he just flat out said, we just need to let supply demand do its thing. And it just has to work itself out. Prices may recede in some areas, prices may not in others. And if we try, us as Americans, especially humans in general, but especially Americans, we're always looking for what's the magic bullet. I want it now. I want it easy. I want it quick. What's the pill I can take? What's the shot I can inject? Like, just what can I do? Give it to me. And this is a classic example of that leading you down a worse path. So I think ultimately the ultimate solution for affordability is it's just going to have to maintain. We're going to have to maintain a level of unaffordability for the next, foreseeable future, or maintain this level of affordability for the foreseeable future until things start to eventually, just kind of balance out. Let's see what we have. We got some people coming in. Okay, Robert, let's see. A macro person on Twitter mentioned that the reduced payment being vested in, oh yes, I've seen this argument, vested in, say, the S&P could yield significantly higher return over the course of the note's term, assuming continued eco growth. So this is the old, with the difference that you save, you could invest it and it could grow and it could potentially offset. This is a kind of a common argument used in the why you should rent as opposed to buy. Rent the house, and then with the difference you save in mortgage versus rent, take that money, invest it into the S&P month after month. And at the end of 30 years, you'll be a trillionaire without owning a home, which maybe not. But there's a lot of things that go into that, which we're not getting into. Monty, what do you think about that? What's your take on, you reduce the payment, take the difference and invest it, and you're in a good spot. What do you think?
I don't know. We look at this a lot when I do analysis for clients about taking, doing a 15-year versus a 30, maybe going with the 30, taking the lower payment, investing the other money rather than putting it into the house. Everybody leverages to use their money somehow. And I think everybody's situation is different. Not every client I have has confidence in putting money into a stock market. They would rather have a lower payment. I mean, everybody's tolerance for that risk is different. So I think that's an individual thing. And I think you have to do the math. I do the math for clients all the time on those questions because it's a math problem.
Yeah, exactly. Hey, Hui, how we doing? Good to see you in the stream. Thanks for hanging out. All right. Okay, we're fine. Rah. That means more leverage, more risk. And if the MBS blows up, the losses all get socialized as bad macro train of thought. Yeah. Innovative. You're gonna come on the show one of these days. You could be on with me next time. You always have such good stuff. Cackleberry, how's it going, Cackleberry? Hope you're doing well up on the hill. Hi, Joe. This is true about social media. We were 24 when we bought our first house at 15% interest and had no idea that was a high rate.
That's right.
Yeah, you just went home shopping and you looked and you said, "Oh, can we afford this? Do we like it? Yeah, okay, we'll buy it." And now we're like, "No, that's the kiss of death. Wait till it gets down." And think about. And this is crazy. And Cackleberry, this is like such a great reason. And Monty, this will come full circle. Think about all those people now on social media that bought into all these housing crash bros, these doomers, these doom porn housing people that are just talking about the sky's always falling. There will always be a run on the bank. It's happening tomorrow. You better believe it. Think about all the people that bought into that noise that have not bought a house in the last 3 to 5 years because they thought, oh, I'm going to listen to this whoever on social media. I watched this one video and they said, don't buy right now because it's going to end up being a problem. And then they don't buy. And then 6 months later, they didn't buy. And then 12 months later, they didn't buy. And now all of the sudden they're looking at houses that are $200,000, $300,000, $400,000 more.
Yeah. Joe, I just did a social media thing on this last weekend. I was in front of a house and made the point that house sold in 2001 for $513,000, and that same house today is listed at $1,588,000, I think, is what it was listed at.
Yeah.
And the point I was making when I did that is in 2001, there was a lot of stuff going on that made you not want to buy a house. We had 9/11, we had the dot-com bubble crash, we had rates over 7%. Every decade, you are going to find some reason that you shouldn't buy a house. There's always going to be some fear, some risk involved.
Every month you could find a reason to not buy a house. I mean, there's like I always say, you can always come up with 100 reasons to not do something.
Yeah.
That, the job, the house, the windows. Right. We don't like the windows. We're not buying it. This stuff. So, but what a great illustration.
But people are rewarded if they have a strategy and a plan. Buying a house isn't just, I went to open house on Saturday and fell in love and it's a great house, I'm going to buy it.
Yeah. Great point.
Financially, there's a strategy behind it. And you have to have that strategy to benefit. I bought my first house and my interest rate was 10.5 on a 10-year ARM, which was crazy. And I was in the business and thought I'd rock the world. But I knew we were going to stay in the house, 5 to 8 years. Well, we ended up staying in the house 10 years because we had a housing crash in Southern California during that time period. But I wouldn't have not bought that house. We got huge tax benefits throughout that time period. We had our house, we refinanced it, got a better payment. I mean, there was no reason not to. And when we sold it, we still made a profit on it.
Exactly. And after all of those wonderful benefits that you just listed that are true to any homeowner or home buyer, for me, one of the biggest ones is you have all of that. Plus on top of that, you never had to worry about coming home to a note on your door that said you got 60 days to get out.
That's right. Absolutely.
Sorry. My nephew's moving in, my brother's moving, my son's moving back, and you got to go. And at that time, you only had 30-day notice because 60-day notice is as of the last couple of years. So to me, just having control. Okay, maybe I'm a control freak. Okay, I get it. But just having that control of being able to choose your destiny with, I know no one's going to knock on my door and tell me, hey, I'm coming in, I got to fix something, or hey, you got to get out, or hey, your rent just went up, $400 or whatever they're going to raise it or anything like that. So you make a great point, and there are so many wonderful things that go into it.
But I don't want anybody to panic because this 50-year mortgage is so far from coming to reality.
Yes, that's a great point. This is solely a verbal proposal, like social media post from the admin. This is, and in fact, correct me if I'm wrong, Mondi, but I believe that right now, the way that the American finance system is set up, we can't even have a 50-year mortgage. You can't
because under the Frank Dodd law that came into effect after 2008, the government created a box, basically, of an underwriting box, if you will, called a qualified mortgage. And if you underwrite the loan to the guidelines within that box, you as a lender, if the client goes belly up, they can't come back at you and say, well, you put me in a mortgage I couldn't afford, which happened a lot prior to 2008.
Yes.
So you hear the term QM and non-QM loans. Well, a 50-year mortgage, one of the underwriting criteria in that box or parameter is it has to be a 30-year or less term. The minute you exceed that term, that's a non-qualified mortgage that cannot be sold to Fannie Mae or Freddie Mac. It is not, you're not protected as a lender. If you put a client into it and they foreclose, they can come back at you and say you didn't do your due diligence in getting them into that mortgage.
Yeah.
So the reality is Dodd-Frank would have to be amended or changed in order to expand the qualified mortgage criteria. And that, you know how that's going to go over with our government right now.
Right.
And,
Exactly.
And then even if we get that done, the secondary market, you've got to have people who want to buy this security instrument.
And somebody that wants to make the loan.
Well, Fannie Mae and Freddie Mac can make the loan, but they want to sell these investments too. They don't always want to hang on to everything. So you've got to have a secondary market that sees value in the instrument and wants to buy it. So I'm just saying that because there are just a lot of hurdles to get over before this becomes a thing. And at the end of the day, if it's not to the benefit of the client, we just don't recommend it to the client. We show them why it's not the benefit that they think it is.
Yeah. And I think that's a great point that even if they did make this, say, okay, let's just say tomorrow they waved a wand. We have 50-year mortgage as an option. When you lay that out as, for the loan menu in front of the client, and they go payment, interest, payment, interest, payment, interest. And they go, wait a minute, interest there is 10,000, interest there is 14,000, interest there is 30,000. Well, I'm just making numbers up, obviously, but the idea is the same. So you make a good point. Even if it was an available tool at the moment, would anybody even use it? I don't know.
Use it.
Yeah, exactly.
Yeah. I mean,
all right. What else we have here? Taking on a mortgage debt is no different than using margin debt to invest in stocks. Yeah. Do you know what happened last time we used margin debt to drive up the stock market? We went into such a deep hole that Roosevelt had to create the 30-year mortgage to bail us out. Yeah, you're correct. And it was so funny. It was so funny that Trump put that graphic up on whatever social media he owns. I don't know, where he's got Roosevelt, 30, and then him, and it's like great American president. It's just. I mean, it's just was funny to me. Whenever you yourself declare yourself great. I don't know. Interesting. MH, hey buddy, how's it going? Thanks for hanging out. Are you starting 30 minutes earlier out? No, this was just a special tonight thing because I'm jetting out of town after the stream. So I needed to start a little bit earlier so that I can get out. So 6 o'clock was just special for tonight. Next week we'll be back at 6:30. Okay. I need a place to call home. I would not choose to rent and invest in stocks without having my home.
Yeah.
Bingo. And I think that is a majority of people really like real estate because you can't live in a stock and the stock market could be wiped out by something that's not your doing. I guess the housing market could be too, we saw that in 2008, but at least at the end of the day, you have a roof over your head. With stocks, you don't. So
the other thing, Joe, is when you invest in a stock, it's dollar for dollar. If I spend $10 on a stock, I get a $10 stock, right?
Right.
When I buy a home and I invest $10, well, let's say $100,000, I get a $500,000 home that's going to appreciate. It's not a dollar for dollar increase in profit, right?
Yeah. Your
asset is worth a lot more than what you invested, and the appreciation is based on that asset, not the $100,000 you invested.
Exactly. And it's one of the few assets that appreciates and also has utility. There's not a lot of assets out there that appreciate and offer utility. Most assets that offer utility, you have to depreciate them. Right. Think about car, machinery, factory equipment, things like that.
Yeah.
Okay, Robert, I think mortgages as leverage can be advantageous for the already affluent, but I agree that it's dangerous leverage for those just staying above water. And unfortunately, this 50-year mortgage is basically targeted and geared towards that demographic of people, the people that, if I could just save an extra $200 a month, I could get into this house. Oh yeah, let's go for the 50-year. It's unfortunate because this 50-year mortgage would only be helpful to just a very sliver of overall home buyers. Hey, Killer, good to see you back in the stream. Thanks for hanging out. Given the cost of materials and labor currently, what do you think of fixer units? Still worth it? Yeah, I do. But here's the thing. You make your money when you buy it, not when you sell it after you fix it up. So just like anything else, you got to get it at the right price. But I definitely think that there still is room let's just take flipping in general right now. The flipping market has gotten a little bit more difficult because inventory is very constricted, and homeowners are now more than ever open to fixing a house up, because between limited affordability and limited inventory, buyers are like, what can I get? Like, I'll just great. If the price is right and I can fix it up and it's in a good spot, I want it. So it is a little bit more difficult. The inexperienced flippers are having a really tough go. The flippers that don't know their numbers, don't know their margins, don't have a routine crew of workers where they know, I know how long this is going to take. I know how much I'm going to spend. I know my crew can flip this in X amount of time. Those are the ones that are still finding success. The amateur flippers that are just like, oh yeah, I'm going to get a hard money loan. I'm going to go buy a house and fix it up and flip it because that's what they do on TV. It still is difficult. So you have to be really good with your numbers, be very good with your comparables analysis. You got to be really good with your renovation costs, but they can still work. And obviously, if you get into multiple units, it's a more expensive upfront investment, but there's more potential reward. So I would be looking at duplexes and triplexes if possible, depending on where you are in the nation. I mean, you can a triplex here in California is going to cost you 1.2 million. A triplex in Kentucky will probably cost you 230,000. So it just really depends on where you're looking and what you want. Your son is a bum. No, my son's not moving back in. My landlord's son is moving back in. And he's the bum, MH. They want to get rid of Frank Dodd. Why am I not surprised? let's just play it loose and fast, baby, loose and fast. What could go wrong? It's not like anything could crash. Have you done the calculation to see how much one would have paid after 15 years in a 50-year mortgage, assuming the median home price is $400,000?
Well, actually, Joe,
that's a great segue, isn't it?
That's very good.
It's like we just should hire Hui real quick and be like, hey, you're gonna intro us all the time. Let's get this up on the screen. Bingo. I think, Monty, this is what you're after.
Yeah. And actually, I did it on a Southern California average home price, which would be $860,000, just to kind of give you another viewpoint. So we took a look at this with 20% down, 688 loan amount. I put a higher rate on the 50-year because we're going to have a higher rate. You know, there's a higher rate from a 15 to 30. Well, we're going to have a higher rate from a 30 to a 15. So I just guesstimated, and so let's put another 0.5% on the rate there. And then ran the payments, and just disregard the cash and close and stuff. That's just estimates. But basically, your payment difference is $218 a month. You're negative $22,000 in the first 5 years, meaning you're paying $22,000 more on that 50-year mortgage in the first 5 years. That's a crazy number.
That's a crazy number. I mean, that's a freaking car. I mean, that's imagine what you could do with an extra 22,000. It's not 10,000. It's not 1,200. I mean, it's 22,000.
You know what I'd advise a client to do? Take that money and pay down your personal debt, because a lot of people are sitting there with personal debt. That could wipe out a lot of people's personal debt over a 5-year period.
And not to mention that personal debt on your Discover card is probably at God knows what interest
God knows
rates.
what rate. Exactly.
14%, 18%. God, who knows?
That's crazy.
What rate?
But scroll down. Here comes the 15-year number. You're talking. Whoops, all the way down. There you go. Nope, keep going. There you go. So after 15 years on the 30-year mortgage, you've paid $581,000 in interest, and you've paid $691 on the 50-year. So what's that? $110,000 more
in just 15 years.
In just 15 years. Yeah. Pretty crazy.
That is crazy. Now
and those would be the numbers we show a client to say, this may not be the right option for you.
Right. Exactly. Now let's just for a moment, Mondi, let's play devil's advocate.
Mm-hmm.
And let's go, okay. So one of the things that not a lot of, but the few people there's some people out there that this administration could put out any piece of information and they would go, yeah, heck yeah, that's great. And those, and listen, this is not a shot at Trump or Republicans. I can already hear the comments raining down on me. This is a shot at people that just live their life by political alignment. So it doesn't matter what you are or where you're at. So in any administration, there's going to be the blind followers that just are like, oh yeah, the guy that I like said it, it's good. Yeah. And the people that are in that boat for this are like, well, the average person's only in their mortgage for 7, 8 years, and then they're out and they refinance and they sell and they buy, and so they can reap the rewards for the first 7 years of a lower payment. But as we just saw, in the first 5 years, you're negative $22,000. So even if you did keep it for 7 years, even if you did, you're still in the hole. Probably at 7 years, you're probably in the hole now close to 25 grand, as opposed to just doing the 30 year. The other kind of devil's advocate argument is, well, you always, and I've heard this too, you always take the longest term on a loan. You always take the longest term, and then you can always double the payment and you can pay it off much faster. Sure. And then if you get on hard times, you can fall back. Guys, that would require borrowers and the common person to have like great discipline and have it always go according to plan. How many times in life have you seen someone go, oh yeah, this is how I'm going to do something, and then 6 months, a year, 2 years later, they're like, no, I'm not doing it that way anymore, and they just slip back into their old way? And on a 50-year mortgage, if you think, oh, you know what, I'm gonna go back to paying the minimum instead of doubling the payment to turn my 50 into a 25. If they slip back to that in year 7, even, let's say there's a medical emergency in year 7, they're like, oh dang, I got to pay the single payment and not the double payment. Now they're flushing money down the drain, and they are going to pay a ton in interest. They'll still pay a ton in interest, especially if that's early on in the loan, because guess what? You pay the interest basically upfront on a mortgage.
All first. Interest goes more than principal at the beginning. Well, yeah. And my argument would be, why would you want to do that and pay 0.5% more so you can take a 50-year versus a 30 and pay extra? Just take the 30.
Just take the 30 at that point.
Yeah.
Just take the 30 at that point, right? Yeah, exactly. I hear the argument to pay extra every month. If you can pay extra, why not take the 30? Right. There we go, MH. Yep, you got it. Indeed, I have no faith on how Americans spend their money. I wasn't going to say it, but I'm glad that you did for me, because that's basically what I was getting at. Take out that 50, then a year later, insurance company says roof needs replacement. Yep, exactly.
I don't think they even say that anymore. They just cancel your insurance.
Yeah, you just get the letter that says you got 6 days. Figure it out. We're done with you. We're dropping you. Best of luck to you. Best of luck to you. All right. I think we just have another couple minutes on this video, so we'll go back to this real quick. We'll finish this one out.
Equity. Graham also said that for all practical purposes, the loan would be more like an interest-only loan, because very few people would keep a home for 50 years. The real question, though, is, can Fannie Mae and Freddie Mac actually do this? Now, analysts say it's possible, but a 50-year mortgage does not currently meet the definition of what is called a qualified mortgage, and that's under the Dodd-Frank Act. It gives investors a backup from Fannie and Freddie if that loan goes bad, as in the homeowner doesn't pay. But regulators were given the authority to change that in order to ensure mortgage affordability. That, however, though, could take a year, according to Jarrett Seaberg of TD Cowen. That's because they need congressional approval.
A year if they can agree on it.
Yeah. Yeah.
If they can even agree on it. Let's see. Do you think a 50-year mortgage will boost home prices? No, I don't think it's going to make a bit of difference. I don't think this product is going to do anything. Honestly, I think the only thing this product is going to do is potentially cost Pulte his job at the administration.
Well, it has done one thing. It's gotten everybody talking about this and not about the fact that the government was just shut down for 40 days.
That's true. That's true. That is true. And then you start to wonder, what is the real story, right? Like what and you do have to wonder, and I don't know. You just never know anymore. You'd think that Bill Pulte, being the real estate guy that he is, just real estate through and through, for him to just nonchalantly throw this out, he knows he can do math.
Yeah, I don't know. I don't know. I've known some top of the house guys that have put some pretty crazy ideas out there. So I don't know.
And the interesting part is, if you know, Bill Pulte used to be, in Pulte Home Builders, right? Pulte Home Group. Well, he still sits on the board of Pulte, and Pulte makes a lot of loans.
Yeah.
They have their own finance company for their new homes.
Yeah.
And guess what? A 50-year mortgage is going to do the most. It's going to, we already talked about, it's going to freaking triple your interest payments.
Right.
Who benefits from that? The person holding the loan benefits from that. So then you start to get a little like, what's really going on
here? If you want to drill deep, actually the federal government will end up holding this loan on some of them because it's Fannie Mae, Freddie Mac. You're not going to see this. You're not going to see this product on a jumbo or some of the other product, but ultimately, the money will go to Fannie Mae and Freddie Mac and their investors on the interest that they make.
Yeah. I mean, so overall, Mondi, I mean, in summation, I think if anybody follows me on socials, I posted about this. I think based on the conversation that we've had tonight, I think it's pretty clear that I am primarily against 50-year mortgages. I shouldn't say that. I'm not against 50-year mortgages. If you want to take a 50-year mortgage and you find someone to give it to you, go for it. But I think in the current landscape, to say that we're going to introduce a 50-year mortgage, it's going to help affordability, it's going to help Americans, it's going to make a difference, I think that's categorically false. I can't see a way in which any of that would actually come to fruition. That's my take. Mondi, what do you think in summation about the 50-year mortgage?
It would not be a program I would sell, for instance. It would, it wouldn't be something I'd go to clients and go, oh my God, you've got it. Now's the time to buy. Look at this great mortgage product we got for you. It's just not that. I have wondered since reading all of this, what the media was like when they rolled the 30-year mortgage out. Because I have to believe that there was a lot of pushback on that too.
Well, and there probably was, Mondi, because when the 30-year mortgage came out, this was in the 30s. Prior to the 30-year mortgage, it was like you needed like 50% down on a house.
Right.
You couldn't do this 10 and 20% thing. Big mortgages were not a thing. It was like you had to have some money. Now, of course, at the time, houses were like $21,000, even less than that, the $10,000 range. But still, all things equivalent, right? And so you're right. I wonder what the
political environment was and what the opinions were. I'm not saying that the 50 year is going to be as beneficial as a 30. I don't believe that to be true. Right. I think a 30 year is a long enough term that you should be able to qualify and get a home. I don't. I am a bigger proponent of let's get the capital gains tax taken care of so we can have more inventory in the market. And that in and of itself will make this market a healthier place. And I don't think this is the way to do it.
Yeah, absolutely. Like I said, when we started the stream, I think subsidizing for buyers and demand is the opposite of what we need to do. I think we need to subsidize the inventory. I think that needs to be done. Like we said, either eliminate or modify capital gains taxes. I saw someone online that said, oh no, capital gains taxes are fine. If someone has made over $500,000 on the sale of a home, they can afford to pay it. And my response was, you live in Arkansas. Yeah. Because I mean, if you live in any major metro area or suburban metro area, I mean, I can think almost all of my neighbors on this street have over $500,000 in equity, and multiple have $1 million or more in equity. Right. Normal everyday people with normal everyday houses. But in this market, in this area, that's what we have. And that's why areas like LA, the suburbs of LA, Miami, the suburbs of Miami, New York, the suburbs of New York, including New Jersey and Maryland and Ohio and those areas, that the Seattle, those surrounding areas, all these major cities, prices keep continuing to go up so high, so fast. And it's because the inventory is the problem. And that's where the people want to live. That's where the housing is most expensive. And that's where capital gains is felt the very most. So that I'm in total agreement. I think we need to incentivize builders to build smaller houses. And I think we need to get rid of capital gains. And I do think that we need to be very careful with institutional investors buying single family homes. I'm saying they shouldn't be able to, because that's a very slippery slope there. But, there's a world where there could be sort of a nice in between, BlackRock being able to scoop up 1,000 homes in Atlanta versus them not being able to do that. I think there's a medium there that we can get to without rocking the boat. Don't tell BlackRock that. Will have me assassinated. All right. So at 65, maybe I should refi to a 50. And there you go. You won't be on the hook for the whole thing. So
at 65, do a reverse mortgage. Don't do it.
I was typing this. I'm curious how people reacted when 30-year mortgages were first introduced. We're on the same wavelength tonight, buddy. No idea that 30-year was a New Deal thing. Sure was. Really helped pull the American economy out of the Great Depression. Really is one of the things, that and the all the public works, the alphabet programs, all that stuff. Southern Illinois, yeah, possibly. I remember when 500K was expensive in the wealthy parts of North Carolina in the 90s. Yeah, exactly. That's what I mean. I mean, if you're in a spot like that on the coast in a desirable urban or suburban area, $1 million homes are nothing anymore. That's just the way that it is. Thanks, COVID. Leslie. Hey, Leslie. Good to see you. Thanks for hanging out. Yes, capital gains need to be addressed. I'm so glad you agree with me. But it's true. It really is true. And the idea that, if you made that much money, you can afford to pay it. It's always easy for other people to spend other people's money. It's wild. It's very easy for those people to be like, oh, no, you can afford that. You could just afford it. You made a lot of money. I know, but the house I'm trying to buy is even more expensive because that's what the market is. And that's what people.
And then you throw in that a lot of those people have a low interest rate as well. That for them to be incented to move, it's going to take something more because they're going to be giving up that lower interest rate, and they're not going to want to do that and take a capital gains hit too.
Yeah, that's a great point, because people are willing to say, okay, you know what? I'll give up 1% on my interest rate. I'll give up 2% on my interest rate, but I'm not paying any capital gains. I'm getting into the house that I want. It's bigger. It's better. It's a better fit for my family. That, by the way, in 2019, when I bought this home, it was a family of 2. And now in 2025, we're a family of 4, and we need a bigger home. Those types of people are going to be okay with saying, okay, I'm going to ditch my 4% and I'll take the 6% because I've got equity from the COVID boom. I can make a big 30% down payment, and I need a bigger house. So, okay, let's do it. But when you have people that are sitting at 2 3/4 or 3 or 3 1/4, or their home is fully paid off and they have to take a mortgage at 6.3% and they have to pay $250,000 in capital gains tax, they're like, why the heck would I do that? I'm just going to sit tight right here. And I don't blame them.
Right.
MH, aren't capital gains waived if you put the proceeds into another property? Correct me if I'm wrong here, Monty. This is no longer a thing, but I believe at some point or in some areas like that, this was a thing, but now, no. Now you might be thinking of like a 1031 exchange, where if you 1031 exchange the property, you can kind of get out of some.
That's an investment property.
Yeah, as an investment property. It has to be an investment property. Yeah. So, but if you're in 1031, you do 1031 exchange, you can circumvent some of that stuff because you're exchanging one property for another. So you can kind of avoid the taxes there a little bit, but not on residential primary. No, the government's gonna get their money from you. They're coming knocking. I need a 50-year loan for my origami house I'm buying off Amazon. I'll just toss all the appliances on the card. Yeah, baby, spend, baby.
And there's a plan.
Anyway. Yeah, there's a plan. You need a plan, and Innovative's got one. Innovative's got one. Folks get mad when you have equity because they think you don't deserve it, but gains on a 401k are okay. Yeah, that is a great point. Yeah, that is a great point, right? You've got money, you can afford it. All right, guys, we are coming up on 1 hour, and you guys know the drill. At the end, what do? We get you to go to my website. All right, guys, so I'm putting the link in chat, workwithjoerealtor.com. If you guys are looking for an excellent agent, I'm not just talking about myself, but if you guys are looking for an agent all over the nation, I have a huge network of trusted agents that we call 20% agents. Mondi will vouch for this. 80% of real estate agents don't know their left hand from their right. And 20% of agents actually can help you. They can actually do a good job for you. I have compiled a list of 20% agents. So if you're thinking about buying or selling in Seattle, Miami, Arkansas, really anywhere in the United States, go to my website. You can click on any one of these buttons, do the thing, do the thing, do the thing. You'll get a form, fill it out. It'll go to me. And then I can get you connected with a great agent in the area that you're looking to buy or sell in. And that way, you know, you're going to be taken care of. And I've got good news. If you're in the greater Los Angeles area, you guys know the spiel. If you guys are in LA County, Orange County, Riverside, San Bernardino County, you can work directly with me. What a treat that would be, right? So go to my website, workwithjoerealtor.com. The link is in the chat. And you can go to the website and get connected with an agent. Mondi, thank you so much for hanging out with me.
That was fun. I've never done this before.
Great.
It was great fun.
Well, welcome to your first live stream. And I hope that everybody in the audience enjoyed it as well.
I hope so.
And we'll be back. Actually, you know what? We won't be back next Wednesday because I'll be out of town. So next Wednesday will be an off week. I know you guys will all miss me very much. I don't know what you'll do on Wednesday at 6:30. I hope you all survive. But we won't be on next Wednesday. So it'll be the following Wednesday after that. So 2 weeks from tonight, it'll be back at 6:30. I don't know what we'll talk about yet. Maybe we'll try to find some dream homes on Zillow. That's always a fun one to do.
Maybe they'll announce a 60-year mortgage between now and then.
Maybe we'll talk about the 60-year mortgage next. Yes, really bring that payment down. The payment will be down. It'll be down by $450, but the interest, oh my gosh, I don't even want to think about it. All right, guys. Well, thank you very much. Oh, salute to the guests. They like you, Mondi. They really like you. Oh, you're welcome, Hui. Thanks for being here. As always, guys, thanks so much for giving us your very valuable time.
Yeah, absolutely.
I know that everybody could be doing a lot of things right now, and I really appreciate you giving me an hour out of your week. So thanks for hanging out with us on a Wednesday.
Thank you.
You guys know the spiel. It's a crazy world out there. It's only going to get crazier as the holidays approach. So, try to just be cool out there when you're out and about in public. Be nice. Use your blinker. Don't yell at people. Spread the cheer, spread the joy. Okay, guys. Leslie, you're always welcome. Thanks for being here in the chat. It's always good to see you guys. All right, Mondi, do you have anything in closing for us?
I'm good. Thank you all. I appreciate it. This was a lot of fun.
Good. All right, guys, enjoy the rest of your week. Have a wonderful rest of your Wednesday evening. We'll see y'all next time. Bye, guys.
Bye.